Hi, this is Jim Pearce, Chief Investment Strategist for Personal Finance, with a weekly update on Friday, January 12th, 2024. The stock market has gained no ground since the start of this year. Yesterday, the S&P 500 index closed at 4780, which is slightly below its all-time high, closing high of 4783 achieved 2 weeks ago. The NASDAQ Composite Index is modestly higher, while the Dow Jones Industrial Average is a bit lower. All three of those indexes are dominated by large cap stocks. So perhaps a more telling statistic is the 5% drop in the Russell 2000 index over the past 2 weeks. That is a meaningful decline in a short period of time, which suggests something more than a technical correction may be at work. So if we look at the S&P 500, let's say over the past 6 months, you see it bottoming out at the end of October and then the big run up at the end of last year. But if I now zoom into just 1 month, you can just see it's pretty much been flat. But if we look at the Russell 2000 over the past 6 months, you see a similar pattern bottoming out at the end of October, big run up, but a much bigger decline here at the end. So if we now cut this back, say to 3 months, you see the peak there, and we go out to 1 month, it's down basically 5% since its peak 2 weeks ago. And that's a meaningful number. So that's something else explaining that drop. Could be a growing concern that a lot of big companies will be laying off employees this year to cut costs. That may help the profit margins for those companies, but hurts the smaller businesses that rely more on consumer spending for most of their revenue. For example, this morning, Citigroup CEO Jane Fraser stated the company plans to eliminate 20,000 positions over the next 2 years. Now, she estimates the payroll savings to be about $2.5 billion. But that's money that will not be spent on consumer items by those soon-to-be former employees. In addition, another 40,000 jobs will be eliminated after Citigroup spins off one of its subsidiaries in Mexico. Now multiply those numbers by a couple dozen big companies, and somebody has a problem. Although businesses of all sizes suffer when job growth stagnates, small businesses tend to suffer the most in terms of sales. And right now, Wall Street is wondering how many more companies may announce job cuts when they release their Q4 results in the days and weeks to come. Wall Street's also getting a little anxious about inflation. Yesterday, we learned that the consumer price index for all items rose 0.3% in December and grew by 3.4% over the trailing 12 months. Both of those numbers were slightly higher than anticipated. Thus far, the bond market is reacting as if nothing has changed. The yield on the 10-year Treasury note opened this morning at 4%, which is slightly below what it was a month ago. And let me just show you, here's 6 months of the yield. You see it peaking here, in October, and then the big drop all the way through the end of December, and now this rise. So if we cut back into a 3-month period, you can see that bottoming out process there. If Wall Street believed that the Fed will not start cutting interest rates this year, the yield would be closer to the 5% level it nearly touched 3 months ago. For that reason, I would not read too much into the slow start to 2024 by the Russell 2000 index. It made a big run up the charts over the final 2 months of 2023, so it may have been a bit overvalued to begin with. Combine that with the possibility of a lot of big companies reducing their workforce, and some of the air goes out of the small cap balloon. And that's this week's PF video update. I look forward to talking to you another week. Thank you.